We thought the results were very bad.
Gordon Johnson was just on TV again, and he reiterated his price target of $24 for Tesla stock after the earnings. Let's take a look.
You are admittedly not a Tesla bull. Help me understand. You have a price target of $24.33, which is a pretty substantial drop from where we are currently.
Even the host understands this is ridiculous. Gordon is being ridiculous.
What's your top line reaction to the results and perhaps more importantly, the guidance looking ahead?
Yeah, I just want to correct you on the guidance. Their guidance is 1.8 million cars sold. He said there's a possibility they'll get to 2. 1.8 million cars sold. On the 4Q run rate is growth of just 11%. On all of last year is growth of just 37%. They've said they're going to grow 50%. That's how the stock is valued.
Double checking Gordon's math, we take deliveries from the fourth quarter for Tesla and we multiply that by 4. We analyze these deliveries and then we add 11%. And yeah, we do get 1.8 million, which is the official guidance from Tesla. So, to me, what this is saying is Tesla is sandbagging this, meaning they know that they can do a lot more, but they're just being conservative, just in case. This is a good way to set expectations. I love this.
Okay, so just with respect to the results, we thought the results were very bad. I know that the stock's reacting positively.
That is quite an understatement. It's rocketing. It's not just reacting positively, it's exploding right now.
But let me run through it. So their auto gross margin fell 319 basis points quarter over quarter. Keep in mind, in the fourth quarter, the price cut was just roughly $5,000 across their suite of cars. In the first quarter, which is what's really important, their price cut is about $5,000 across their suite of cars. So their gross margins fell 319 basis points with the price cut in Q4.
Yeah, gross margins, as if that was the profit number, the bottom line. The number that actually matters is the operating margin, and that has increased still, despite gross margins shrinking. Gordon is definitely going to mention that, right? Right?
Let's look at some other Q4 items. Their inventory in Q4 is up 120% year over year.
Tesla is increasing some of the inventory on purpose because that's the only way that you can reduce the quarterly wave at the end of each quarter. You can see that in Europe, the deliveries are beginning earlier now instead of all of the deliveries happening just at the end of the year, which will lower costs. Therefore, improving operating margin, which Gordon was complaining about. Well, he was complaining about gross margin, which does not matter nowhere near as much as the operating margin.
In addition to that, Elon Musk clarified yesterday that their guided 1.8 million of sales this year is not supply constrained. What that means is there's just not demand for their cars. And given that he also confirmed that their price cuts equated to just 1 month of orders.
Gordon mentions what Elon said, but then conveniently forgets somehow that Elon also said on the earnings call that the order rate is double the production rate.
That means they're probably going to have to cut prices again in 2Q.
Another conveniently forgotten fact, Tesla just increased prices slightly for the Model Y.
So we can get into some more stuff, but I think this was a bad quarter.
If by bad quarter, Gordon means due to reasons that are outside of Tesla's control, such as this, and literally all the people that I know that are Chinese, I asked them, is everyone sick in Shanghai? They said everyone literally had this virus, especially at the end of December. Also, remember back around here when it appeared, oh, there is perhaps no more demand for the Model S and then Model X. And then Tesla, of course, introduces the Model 3 and boom, sales more than double in just one single year. I believe the same thing is going to happen once the new next generation platform is introduced. Can't wait to hear more about that on the Investors Day coming up soon.
So I take your point that their margins are definitely being squeezed in the midst of these price cuts, but some would argue that they're making a more long-term play, right? They're sacrificing their margins now, at least this is what some of the bulls would say, so that they can get the volume in the future. Do you not buy that?
It's not that I not buy that. Let's run through some numbers, right? So the profit, their net profit, which includes all their service, their regulatory credits and their FSV revenue, their net profit in Q4 was about $3.7 billion. Over 405,000 cars sold. That works out to a profit per car of about $9,000, right? Their price cut on average in Q1 is $5,000. So assume they get another $1,000 of cost savings and you get a price cut of $4,000. You take that $9,000, subtract $4,000, you get $5,000 per car. That's profit, right? Net profit. You multiply that by their 1.8 million of guidance, and you get a number divided by their shares outstanding of about $2.69 per share in earnings. The street is currently at $4, and $2.69 per share, based on where the price is today, is a 55 times multiple. That means that the street is saying they're going to grow 55% for the next 10 years, where they're guiding you to basically 11% growth this year. So it's not that I don't buy it. It's just that the valuation doesn't even match their numbers. So anybody who's buying the stock at these prices today, I think is going to be hurt pretty badly.
And yet not a single mention of decreasing commodity prices, 4680 batteries, which are going to be cheaper to produce, gigacastings being implemented in every factory eventually. Right now, only Texas-made Model Ys receive both front and the rear gigacastings. Everywhere else, they only get the rear gigacasting, and none of the Model 3s anywhere produced in the world right now get any of the gigacastings yet. Think about cost savings there once that technology is fully implemented. And not a single mention of the factories that Tesla has, for example, in Berlin and Austin, that are being ramped up, that naturally right now are not really making money yet. When we compare these two to Giga Shanghai and Fremont, Gordon completely, conveniently ignores all of that. In another interview, Gordon also liked mentioning Morgan Stanley and how their earnings estimates for this year are quite low. But then he conveniently ignores that Morgan Stanley is projecting their earnings to grow later, and also that their price target, despite all of that, is $220.
I want to we can pull up sort of where volume has been over the last few years, Gordon, because I think that's the point you're trying to make, right? Essentially, if you look at sort of the last few years, 1.8, it's still strong growth, but not necessarily what the multiple would imply. Production target appears not so realistic according to you. There does seem to be some debate, though, about whether Tesla does, in fact, have a demand problem. I know you think that they have a demand problem. Elon Musk addressed this on the call yesterday, essentially saying he wants to put the issue to rest, saying they had one of their the strongest January in terms of sales. Why do you think Tesla has a demand problem?
That's a great question. So the reason why we think they have a demand problem is very simple. BYD has increased prices in China 2 times thus far. VW is increasing prices in China. Tesla is aggressively cutting prices, not just in China, but the US and Europe.
Here is 2022 data for sales in China only. This is number of sales. And here is price in RMB. As you can see, Tesla sells in a much more expensive segment. BYD mostly sells in a much cheaper segment. Gordon also conveniently forgets that China's BYD sells more cars when we include hybrids, but Tesla makes 8 times more profit per vehicle. At least it did before. And after these price cuts, Tesla will still make substantially more per vehicle than BYD. BYD cannot cut prices unless it gets subsidized by the government.
Currently, Tesla's run rate demand is about 1.75 million cars per year. Their capacity right now is roughly double that. So they're not even selling half of their existing capacity. That is the quintessential definition of a demand problem, a company cutting prices that can't sell its existing capacity.
Out of all of the vehicles that Tesla is already making, Tesla is only planning to ramp up the Model Y significantly. And the Model Y is selling extremely well. You can see that there is only 258 vehicles in inventory. And how many of these are under $55,000 so that they do get that $7,500 EV tax credit? 1, 2, 3, 4, 5. They will be gone very soon.
But if you look at the numbers do not paint a good picture. And that's why the auto industry trades at 6 times earnings, not 55 times earnings, which is what Tesla is currently trading at.
Gordon, of course, conveniently does not explain that stocks do not trade based on which industry they are in. They do trade based on earnings growth. And for Tesla, we look at the forward projected PE ratio and we see 27, because if Tesla stock does not go up, but the earnings go up, then the PE ratio gets better. But for example, you look at BMW, currently their PE ratio sure is super cheap, 3.3, but the forward PE ratio is 6.43. That means that everyone thinks BMW is going to make a lot less money. That is why the PE ratio would increase. The lower the PE ratio is, generally, the better the deal is. But if your company is going to not be making any money because you have not made any good investments into the EV transition, everyone is just going to think that you are going to go bankrupt, and therefore they will assign this supposedly cheap valuation because they do not think you will do well.
Even Morgan Stanley, one of our competitors, said the number's probably going to come in at $3 this year in their note this morning. If that is indeed the case, this stock is going to come down a lot. Look, I know it's up a lot today. I think it's due to a lot of misunderstandings, misreadings.
Look at the host. Even she thinks, you don't know what you are talking about, do you?
I think it's due to a lot of misunderstandings, misreadings, but these were not good numbers. And the guidance, the implied guidance for Q1 suggests a number of like 76 cents when the street's at $1. So I think you're going to have more earnings revisions. Be careful on this stock.
Gordon Johnson, unfortunately, we have to leave it here. But look, I appreciate the enthusiasm and the passion, and we'll have to see what happens with Tesla stock because, look, as we pointed out, last year was a rough year, but so far this year, certainly starting off strong. Gordon Johnson, thank you.
At the end, she had that face, you know, when a kid tells you, oh, my dad beat Michael Jordan at basketball. And still, she kept her cool and did a great job. She was very respectful. And this is the buying opportunity of Tesla stock explained by Elon Musk. My name is Matt Posis. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.